So you've got a little bit of money lying around and you figured it's time to start making that money work for you. Perhaps you've heard the term investing and how people make an insane amount of money in the stock market, in crypto and in real estate. For example, you've heard that if you had invested $1,000 say in Apple or Tesla about 10 years ago, by now you'd probably be a millionaire, or even in Bitcoin in 5 years ago. So you figured, I'm gonna give this a try. But wait, you're not really sure how to do that. Even if you know how, you're really scared about losing all your money, because this investing thing has been perceived as a very complex and risky endeavor reserved only for the financial experts. Well, this misconception has hindered a lot of people into taking the very first step towards investing and financial freedom. But the truth is, with the right guidance, anyone can start investing, which is why in this video, I'm going to talk about why you should be investing, where you should be investing your money, and how to start investing now. I'll also talk about how I invest my own personal finances. This is a video I wish I had when I started my investment journey. Let's get started. Hi, my name is Chika and I'm an Oxford graduate and management consultant with an MBA qualification. But one thing I'm not is a financial advisor, which is why this video, just like my many other videos, is only for educational purposes. Share my own personal experiences and lessons I've learned along the way. With that out of the way, welcome back to the channel where we discuss all things personal finance using real life case studies and experiences. And in this case, tutorial. This video has been split into 3 sections: why you should be investing, where should you be investing your money, and how do you start investing now. Feel free to move around to whichever section appeals to you using the timestamps below. Firstly, why should you be investing? Before diving into the how-tos, it's crucial to understand why investing is very important. Simply put, investing allows you to grow your money over time. Investing means putting money into something that you expect will generate a return in the future. A timeless example is in the real estate business. Hypothetically speaking, let's say you buy a house in Babylon for $120,000 and then you rent out this house for $1,000 a month just because the Kens and Barbies are super rich. This means that every year you should be making $12,000 and in 10 years you would have recouped your investment. Any money beyond that point will be pure profit. So you decide to sell this house at this point, there's a good chance that the house would have appreciated over time and will be worth say $200,000. So you would have succeeded in almost doubling your initial investment. Why this is an hypothetical and simplified example, that's exactly how investing works. You put your money into something that you expect will generate a lot of return in the future. But why should you really care about investing? If you've been paying any attention to the news in any capacity whatsoever, you probably have heard the term inflation, which simply means the stuff you buy gets more expensive over time. For example, you might have noticed that when you walked into your grocery store to buy that Cheetos you love so much, the pack is suddenly smaller, but the price is still the same. Or the pack remains the same, but the price is higher. That's inflation. It means you are getting less for the same amount of money over time. A classic example of explaining inflation is that in the 1970s in the United States, a cup of coffee cost 25 cents, but in 2019, that same cup of coffee cost $1.59. And today, it costs about $3. So if you had been alive in the 1970s and put your 25 cents under your mattress, by today you won't be able to afford a cup of coffee. Well, let's consider the alternative, which is putting your money in a savings account rather than under your mattress. Until recently, the interest rate on savings account has been ridiculously low at 0.05%. In other words, if you put $1,000 in a savings account with an interest rate of 0.05%, you'll be making a whopping 50-cent interest, while at the same time, the purchasing power of your $1,000 would now be worth $970 thanks to the 3% inflation. These guys, the US Federal Reserve, targets an average inflation rate of 2 to 3% over time by setting its benchmark federal fund rate. So it almost is a guarantee that your money will continuously lose value over time regardless. So what can you do to manage this risk? How can you grow your money to keep up with inflation or even outpace inflation? That's where investing comes in. Second bit, where should you be investing your money? If you were like me when I started investing, you will be overwhelmed by many different options out there. For example, we have stocks, we got bonds, we have real estate, we have commodities, we have crypto, and so many others. As if that wasn't confusing enough, under stocks, we have categories like growth stocks, we've got value stocks, we've got dividend stocks, ETFs, mutual funds, index funds. For bonds, we've got like government bonds, we've got municipal bonds, we've got corporate bonds. For real estate, you've got investing in single family houses, in corporate houses, in corporate commercial real estate, and in REITs. Oh, and let's not forget crypto. You've got coins, you've got tokens, you've got layer ones, you've got layer twos, you've got metaverse, and the list goes on. So I'm not going to spend time explaining all these things, as this will make for very long and boring videos. And quite frankly, I just don't understand them all. Chances are that as a beginner, you don't have enough money to go into real estate, which has a very high barrier to entry. But even if you do, you probably don't have enough knowledge to be risking that much money anyways. So that rules out real estate. And unless you're looking to retire within the next 5 years, which based on my viewer demography, most of you are not, that kind of rules out bonds, which are generally considered safer but offer lower returns. And finally, as a beginner investor, you probably should stay away from crypto until you've moved a little further into your investing journey. So that leaves us with stocks, which is where most of our money as beginners should be going as a first step in the investment world. The word stocks, shares, and equity are often used interchangeably, and for the purpose of these videos, as beginners, they're going to mean the same thing. So what does it mean to buy a share? It basically means that you are buying a part ownership of a company. Inherently, it means you are betting on two things. One, the success of the company, and secondly, people's perception of the company. Let me explain. Suppose you bought one share of Apple for $40 in December 2018. You would have earned an average of about 77 cents or 20 cents every quarter on your investment since 2018 in something called dividends, which simply means a company's profit that is distributed to all its shareholders. Fast forward to 2023, that same Apple shares you bought for $40 is now worth $190. So if you decide to sell, you'll be making a profit of $150, not adjusting for inflation. This income is called capital gain, which simply means the profit you earn from the sales of an asset that has increased in value over time. In this scenario, you are betting on Apple's success as a company to be profitable, and in turn makes you some passive income as dividends. But you're also betting on people's perception of Apple, because if people perceive Apple as a company is going to fail soon, they will start dumping their shares, which will drive the share price to zero and then make your share worthless. Here's another scenario. Tesla, for an example. Tesla is one of the most hyped companies in recent times. But do you know that Tesla only became profitable in the year 2000? Until date, Tesla still doesn't pay their shareholders any dividends. However, if you had bought one Tesla share on the same day in December 2018 at say $20, in 2023, that share will be worth $280. And at the top of the market in November 2021, that same share will be worth $400. So why are the stocks of a non-profitable company skyrocketing that much? The answer lies in perception. A stock is priced at what the market perceives the price to be. So, should we all run out and invest all our money in Apple and Tesla, or the latest hot stock everyone is talking about? Well, let's hear from one of the greatest investors of all time. Let's hear what he has to say.
The average person will not know enough to know which stocks to buy. They won't know enough to know when to buy them, but they don't have to, because if they can buy all of America through an index fund.
So, unless you're a seasoned investor who researches companies for several hours a day, then you shouldn't really be investing in individual stock, at least not with 100% of your money. Buying an individual stock is like putting all your eggs in one basket, which is quite risky, as you will know, in the long term. Take a company like Intel as an example. It was one of the most valuable companies in the early 2000s with a share price of about $75. If you had been unfortunate to pile all your life savings into Intel at that price point, by 2023, you would have lost 53% of your portfolio, as the share price is now worth closer to $35. Consequently, companies like Apple, Tesla, Amazon have done really well in the past 10 to 20 years, but the past is not an indication of the future, which is why, as a beginner investor, you want to buy most, if not the entire market. This way, if one company fails, its impact to your portfolio is quite minimal, and one way to actually achieve this is through index funds. So, what are index funds? Let's start by splitting it into two: index and fund. A fund is basically money collected from several investors and pooled together into a single basket with the aim of growing the value of the basket over time. This basket, or funds as you call it, is often managed by really smart professionals with fancy degrees from prestigious universities, and their main goal is to beat the market and generate more wealth for the investors. As a consequence, they charge really high fees called expense ratios ranging from between 1 to 2%. They are mostly regarded as mutual funds. An index, on the other hand, measures the performance of the stock market or a subset of the market. For example, the FTSE 100 tracks the performance of the stocks of the 100 biggest companies in the UK. The S&P 500 tracks the performance of the stock of the top 500 biggest companies in the US. We also have things like the Nasdaq, Dow Jones, and so on. So if we put these two terms together, index and fund, we get index fund, which is a fund or a basket that contains all the stock tracked by a particular index. Index funds are not professionally managed by people, which in turn keeps the fees very low. For example, the fees for investing in the S&P 500 is about 0.07% compared to an actively managed fund of 1%. Also, index fund offers a much needed diversification, as you would automatically be investing in different companies like Amazon, Apple, Johnson & Johnson, different sectors like technology, utilities, healthcare, and also in some cases different asset classes like the real estate through REITs. Let's take a closer look at the S&P 500, which is often considered as the benchmark of the stock market. You should see 500 of the biggest companies in the United States, some of which you may be familiar with, some not. If you had invested $1,000 into this fund, it will be divided automatically according to the ratio of the individual stock in this fund. For example, since Apple makes up 7.357% of the fund, it would mean you will be allocated $74.56 worth of Apple stocks. For Amazon, you get about $32.63 worth of stock, and the list goes on. So no one single stock can ruin your portfolio. If you look at the performance of the S&P 500 since its inception in 1980s, you will notice that it has been in an upward trend through thick and thin. For example, even in 2000 during the dot-com bubble, or in 2011, or in 2008 housing bubble, and more recently during COVID, the market dips significantly but always recovers and trades even higher. And this is because the stocks you are investing in are real companies that continuously provide value on a daily basis. People like you and me will wake up every day and continue to work to feed into this stock market machine, whether directly or indirectly. Historically, the S&P 500 has returned an average of between 10 to 12% in the last 20 years. Guess what? In year 2000, rather than investing in Intel and losing 53% of your investment by today, if you had invested that same $1,000 in the S&P 500 and reinvested all the dividends, today your investment portfolio would be worth a staggering $3,828 without adjusting for inflation. Now, the third part, how do I start investing? If you're still watching, at this point, hopefully you understand why you should be investing and exactly where you should be investing your money as a beginner to ensure you are safe and well diversified. But now comes the real question, how do you actually start investing? Well, the very first step is to assess your financial health. First and foremost, you need to do a financial health checkup. Examine your income, debt, expenses to know exactly where you stand. If you have any high interest debt, it makes no sense trying to play the market when you can get a guaranteed return by clearing those debts. For a step-by-step guide on how I did just that, check out this video. Then, you have to create an emergency fund. Many experts have suggested saving between 3 to 6 months worth of living expenses and storing it in a high yield savings account. So it's doing some work while it's on standby. It's important to remember that this is not your everyday expense money. This is solely for an emergency. For example, if you lose your job and have to care for yourself for the next couple of months, or if you have a medical emergency, or suddenly you have to replace all your car tires. And during this assessment stage, you need to always remember that investment is a risk and you could lose a significant portion of your money as nothing is guaranteed. But then again, there are no guarantees in life, is there? Secondly, is goal setting. You need to decide what you are investing for. Is it for a dream home? Is it for retirement? Or a lifetime supply of avocado toast? I'm not judging. Knowing your goals will help you decide how to allocate your funds. For example, short-term goals like buying a house or retiring in 5 years might lean towards less risky investment like bonds, while long-term goals like a 20-year-old who has over 45 years before retirement can afford to ride the stock market wave. You need to figure out your risk tolerance. Are you okay with really big swings in your account, or do you just want to see it grow steadily over time? What kind of investor are you? Are you hands-on or passive? Do you want to be bothered by everyday management, or do you just want to buy index fund and never look at it again? Okay, now for the fun part, choosing an investment platform. Or as some would say, choosing a broker. It's like choosing your Hogwarts house in Harry Potter it actually shapes your investment journey. Each platform has its own perks and fees. Some platforms even offer robo-advisors. Think of this as your own personal Dumbledore guiding you through the magic of investing. But for the sake of simplicity and as beginners, choose a platform that offers you low-cost index funds. Personally, I use Vanguard, but there are others out there like Fidelity, Higris Lansdowne, Trading 212, Invest Engine. A quick Google search in your jurisdiction will show you a variety of options. Just make sure to research them rigorously if they are not a household name like Vanguard. First, you want to sign up for a tax advantage account like the Roth IRA in the US or the ISA in the UK. Check if your country offers any such account. Simply put, with this type of account, you don't pay any capital gain tax on your returns, which is why this should be your first vehicle of investing. There's always a limit you can contribute to this kind of account. So once you have maxed that out, then open up a general investing account that is subject to taxes. I will not be covering 401ks or pension, as in most cases, you generally don't set this up yourself. Your employer often does, but do take advantage of any of such benefits if they are being offered in your workplace. How much should you start with? This is a very controversial aspect, as most people will say, start as soon as possible so you can gain from the magic of compounding. But the fact remains that this is only reasonable if you have a consistent and reliable way of generating income, for instance through your salary or a steady passive income. Then you need to start ASAP. But if you only add $100 to your name and you are adamant on investing in the stock market, let me paint you a picture of how your investment will go. Say you earn an interest of 10% annually. In the first year, you would have made $10, and with compounding in 30 years, adjusting for inflation, you would have earned a total of $718.89. This is hardly retirement money. If you only have little money that's not consistent, then you are better off investing in yourself, learn new skills, or start a side hustle. And when you have enough income, paid off any high interest debt, taking care of your monthly expenses, and saved up an emergency fund, then you can start setting aside money monthly to invest into the choice of index fund. If you're still having trouble trying to figure out how to make more money or increase your salary, then you should check out this video on how to make a six-figure salary in a very short time frame in your career. Do I practice what I preach? Yes, I absolutely do, but with a tiny exception. You see, I am a very active kind of investor with a very high risk tolerance, which has led me into many hot waters like borrowing $25,000 and investing in crypto in 2018, which is another reason why you shouldn't be taking any financial advice from me. Call your financial advisors. But I've learned a lot from these experiences and from lots of investment research and seminars. Now, I put 90% of all my investable assets into low-cost index fund, mostly the S&P 500, and a target date fund. And to satisfy my impulsive nature, I set aside 10% of my portfolio to active investing. Some might even call it gambling. That money goes into individual stocks like Tesla, Apple, Amazon, and cryptocurrencies like Ethereum and Solana. But that's just me. If you're new to investing, I would echo Buffett's words once again. Stick to low-cost index funds. I really do hope you found this video useful, and if you did, hit that like button for the YouTube algorithm. Consider subscribing if you haven't already done so, and maybe share this video with someone you think it could help. Always remember, you're braver than you believe, stronger than you seem, and smarter than you think. Thank you for watching. See you in the next one.